Most people start their morning the same way. You check your phone, scroll a little, maybe glance at your bank app before you even get out of bed. It's not because you're obsessed with money. It's because money is oxygen in the system. Rent, groceries, gas, bills, everything depends on that number being there. Now imagine opening your Wells Fargo app and seeing something you have never seen in your life. Zero. Not low balance, not pending deposit, just a clean, brutal 0.00, like your financial existence had been wiped with a keystroke. If that happened to you, you weren't alone. And no, you didn't imagine it. Millions of customers woke up to the same thing. Paychecks that were sent hours earlier were simply gone. And when people tried to call the bank, the lines were jammed. Social media exploded with screenshots. Entire timelines filled with the same image. Account balance, zero. Available balance, zero. Wells Fargo, one of the largest banks in the country, stayed silent for more than 6 hours. 6 hours. In the middle of a weekday morning, while people were trying to pay rent, while debit cards were being declined at grocery stores and gas stations, while landlords were threatening late fees and people were stranded at pumps with empty tanks. And when the bank finally spoke, the explanation was simple. Technical glitch. That's the story being repeated on every major financial network. Neat, tidy, comforting, nothing to worry about. Go back to sleep. Except that explanation makes no sense. This was not some minor app bug that affected a few users. The outage data tells a very different story. Reports began flooding in around 4:30 a.m. Eastern, while most of the country was asleep. Not during business hours, not during heavy daytime traffic, right in the middle of overnight batch processing. And the spike wasn't gradual. It went vertical, from almost nothing to tens of thousands of reports in minutes. That's not a random software hiccup, that's a system-wide failure. In plain English, something big hit a wall all at once. To understand why that matters, you need to know how your paycheck actually moves. When your employer sends your direct deposit, it goes through the automated clearinghouse network. The money is queued overnight and released to banks in the early morning hours, usually around 3 a.m. Your bank is supposed to credit your account almost instantly. That process has worked quietly for decades, until it didn't. When the ACH network tried to push billions of dollars into Wells Fargo accounts, the system failed. Instead of updating balances correctly, accounts defaulted to zero. That means the ledger couldn't reconcile. The bank says it was a technical error. But here's the uncomfortable possibility. This wasn't a software problem, it was a money problem. Because if the cash had been sitting there ready to go, the system wouldn't have frozen. Ledgers don't panic. People do. Systems break when reality and accounting stop matching. And it took them more than 6 hours to fix it. That matters too. If this were just a coding issue, it would have been patched quickly. Instead, it dragged on through the entire morning, which suggests they weren't rebooting servers. They were scrambling to plug a hole. This is where fractional reserve banking enters the picture, the part nobody explains to you in school. When you deposit $1,000, the bank does not lock it in a vault with your name on it. They keep a fraction and lend out the rest. Your money becomes the foundation for loans, which become new deposits, which become more loans. The same dollar is promised to multiple people at the same time. It works as long as everyone trusts the system and not everyone asks for their money at once. The entire structure runs on confidence. The moment a confidence cracks, the math gets ugly. Let's do some rough numbers. Wells Fargo has around 70 million accounts. Suppose only 10 million of them were expecting a direct deposit that morning. If the bank was short even a few billion in immediately available cash, the system would choke. Not because the bank is poor, but because its assets are tied up in long-term loans and bonds that can be sold quickly without massive losses. And that's the real problem hiding under the surface. Banks are sitting on mountains of bonds purchased when interest rates were near zero. Since rates shot up, those bonds are worth far less on the open market. On paper, they're carrying them at full value. In reality, they're underwater. They can pretend those losses done T exist as long as they done T have to sell. But if cash demand spikes, pretending ends. So what do banks do in that situation? They stall. They float the books. They call it a glitch. And behind the scenes, they borrow emergency cash from the Federal Reserve to cover the gap. That's not conspiracy. That's standard crisis playbook. The uncomfortable truth is that your deposits are being used as collateral to borrow money to cover other deposits. It's financial musical chairs, and as long as the music plays, nobody notices there are fewer chairs than people. This is exactly how past failures started. Northern Rock in 2007, Silicon Valley Bank in 2023, different triggers, same mechanics. A liquidity squeeze exposes losses that were always there. What makes this more serious is that Wells Fargo doesn't exist in isolation. Banks are linked through the interbank lending market. If one bank is short on cash, it borrows from another. If that bank is strained too, the risk cascades. This is called counterparty risk. The danger that your survival depends on someone else not failing first. In 2008, Lehman Brothers collapsed over a weekend. By Monday morning, banks across the world were in trouble simply because Lehman couldn't pay what it owed. Contagion spread in hours. The system froze. That's how modern banking fails, not slowly, but all at once. Today, every major U.S. bank is carrying large unrealized losses on its bond portfolio. According to federal data, the total is in the hundreds of billions. These losses are hidden by accounting rules that allow banks to pretend nothing is wrong as long as they plan to hold the bonds to maturity. Plans, unfortunately, do not stop bank runs. If depositors demand cash, bonds must be sold. The moment they are sold, losses become real. Capital vanishes. Regulators step in. Shareholders are wiped out. That's the sequence we just watched with Silicon Valley Bank. Now ask yourself, what if this morning wasn't a harmless bug, but a small preview of what happens when a large bank briefly hits a liquidity wall? For a few hours, millions of people were shown the truth of digital banking. The number on your screen is not money in a vault. It's a promise, and promises only matter if the system behind them is stable. Most days, it is, until it isn't. This is why the explanation matters. Calling this a glitch frames it as meaningless. Calling it a stress fracture frames it as a warning. Because confidence is the real foundation of the financial system. Once people stop believing the money will be there in the morning, everything changes. And that's the real risk. Not that a single bank had a bad morning, but that for a few hours, millions of people were forced to confront something they were never supposed to see. The system's balance between trust and reality is thinner than it looks. And when that balance slips, it doesn't do so gently. It snaps. You don't usually see the plumbing of the financial system. It's designed that way. Money is supposed to feel boring, stable, and visible. You tap your phone, numbers move, life goes on. Nobody is meant to think about what's happening behind the screen. Until one morning the screen goes blank. That is effectively what just happened. And it should scare you more than any market crash headline ever could. We were told this was just a technical glitch, a harmless computer error, one of those things that happens in a complex system. Move along, nothing to see here. But the timeline alone destroys that story. The first alarm started around 4:30 in the morning, long before markets opened, while the overnight systems were running. And Wells Fargo said nothing for more than 6 hours. 6 hours and 13 minutes of total silence while millions of customers were staring at $0 balances and wondering whether they could buy groceries or pay rent. Now ask the obvious question. What were they doing for 6 hours? They were not just rebooting a server, they were making phone calls, emergency phone calls. When a major bank suddenly can't settle balances, there's only one place it goes: the Federal Reserve, the discount window, the lender of last resort, the financial emergency room. And here's where it gets interesting. 16 minutes after Wells Fargo finally released its statement, the Federal Reserve published its weekly balance sheet. Buried deep in the footnotes was a line most people will never read. $4.1 billion in overnight repurchase operations with primary dealers. That is not routine. For the past several months, the average has been under $1 billion. Suddenly it jumps to over $4 billion in a single week. Quietly, no press conference, no breaking news banner. Because if the Fed stood at a podium and said, "We just injected billions in emergency liquidity to stabilize a major bank," the calm would evaporate instantly, so they whisper it in spreadsheets instead. This is how modern financial crises are managed, not with sirens, but with footnotes. And this is not just about one bank having a bad day. This is about a system that is running far closer to the edge than most people realize. The entire structure of modern banking depends on confidence. Not gold, not cash, confidence. Your dollars are not backed by a physical asset. They have not been since 1971. They are backed by belief. Belief that the government will behave responsibly. Belief that banks are solvent. Belief that the system will keep working tomorrow. But belief is fragile, and nothing damages belief faster than opening your banking app and seeing zero. In that moment, millions of people learned a lesson they were never supposed to learn. Their money is not a pile of cash somewhere. It is a database entry, a digital promise. And digital promises can disappear. That realization is dangerous for the system because once people understand that, they start thinking differently. They stop assuming. They start hedging. And hedging is how bank runs begin. And the official narrative says everything is now fixed. Deposits will be credited. Apologies will be issued. The media will move on. But the psychological damage is already done. 10 million people just experienced what it feels like to be financially erased. And some of them will not forget it. Even if only 5% decide to withdraw a little extra cash, just in case, that is enough to strain any bank. Not because banks are evil, but because they are not built to handle synchronized fear. The system works beautifully in calm times. It breaks in panics. First come the long lines at branches, then daily withdrawal limits, then temporary maintenance on ATMs. And by the time people realize what is happening, the doors are already locked. That sequence has played out many times in history. The names change, the mechanics do not. And this is where the comforting story about deposit insurance enters the picture. You are told your money is safe up to $250,000 because the FDIC guarantees it. What they do not tell you is that the FDIC insurance fund holds about $128 billion. Total insured deposits in the United States are nearly $18 trillion. Do the math. That is coverage of well under 1%. It works only if failures are isolated, one bank at a time. If several large banks fail together, the fund is instantly exhausted. Then the government steps in. And how does the government pay? By printing, which means you technically get your dollars back, but their purchasing power is shredded. You are not robbed directly, you are robbed quietly through inflation. It is the oldest trick in finance: debase the currency to save the system and tell the public they were protected. History is full of examples. Different flags, same outcome. This is why what happened matters so much, not because a bank app glitched, but because it exposed how thin the margin of safety really is. Your deposit is not legally your property once it enters the bank. It becomes an unsecured loan to the institution. You are a creditor, not an owner, and in a failure, creditors are last in line. This is not theory. It happened in Cyprus in 2013 when depositors' funds were seized to recapitalize banks. Perfectly legal. Shocking to those who thought their accounts were untouchable. Trust is not a contract. Trust is a feeling. And once broken, it is very hard to restore. Zoom out and you see this is not just an American problem. European banks are deeply entangled in derivatives. Japan's central bank has effectively nationalized its bond market. China is dealing with a historic property collapse that has wiped out household wealth. These are not isolated cracks. They are stress fractures across the global system. And the trigger is the same everywhere: interest rates. For more than a decade, money was free. Banks borrowed cheaply and lent profitably. When rates shot up, that math flipped. Old assets lost value. Balance sheets weakened. Losses were hidden with accounting rules. The system did not become healthy again. It became fragile and quiet. Quiet systems look stable right before they break. This is why physical assets are being discussed again, not as a get-rich-quick scheme, but as insurance. A silver coin does not depend on a server staying online. It does not rely on a clearinghouse settling overnight. It does not vanish because of a database error. You can drop it on your foot, which proves it exists. Painful, but reassuring. When digital systems wobble, tangible assets suddenly look very attractive. And this is not about panic. It is about diversification. Do not keep everything in one place. Not one bank, not one asset, not one system. Keep some cash for emergencies, not as an investment, but as a bridge if payments fail temporarily. Own things that do not require someone else's promise to be valuable. Because we are living through a transition period. The old system is still functioning, but it is under strain. And strained systems behave unpredictably. What happened this week may be brushed off as a one-day event. But in reality, it was a stress test, a brief moment where the illusion cracked, and millions of people saw behind the curtain. Once you see that, you cannot unsee it. The question now is not whether the system will face more pressure. It will. The question is whether you will still be relying on blind trust when it does. People assume financial crises begin with explosions, sirens, headlines, markets, and free fall. In reality, they usually start with something much quieter, a malfunction, a delay, a small break in the machinery that most people barely notice. That is why what just happened should not be dismissed. We were told this was just a routine technical error, nothing systemic, just a hiccup in a very complex system. But complex systems do not fail in isolation. They fail under stress. And the evidence suggests the system is under far more stress than anyone is admitting. Consider the sequence. Reports of missing balances and frozen accounts started before dawn, not during heavy traffic hours, not during peak market volatility, but right in the middle of overnight settlement when trillions of dollars quietly move through the pipes of the financial system. And then nothing. For more than 6 hours, one of the largest banks in the country said absolutely nothing while millions of customers stared at empty accounts. Banks do not stay silent during minor glitches. Silence means escalation. Silence means lawyers, regulators, and central bankers are already in the room. And then quietly, the Federal Reserve releases its weekly balance sheet. Most people never read it. It is dense, technical, and boring by design. But buried in the footnotes is a sudden spike in emergency liquidity operations. Over $4 billion in overnight repo lending, far above the recent norm. That is not routine plumbing. That is financial adrenaline. Central banks do not inject billions overnight unless something is breaking. They just prefer to do it quietly. Because confidence is the real currency of the banking system. Once that is lost, no amount of official reassurance can put it back in the bottle. And that is the deeper issue here. Millions of people were reminded, in the most personal way possible, that their money is not a physical thing. It is an electronic promise, a line of code that can vanish when systems fail. That realization lingers. Even if the balances are restored, the doubt remains, and doubt is contagious. This is how systemic events begin, not with a collapse, but with a crack in trust. Now connect this to what is happening in the metals market, because the same stress is visible there too. For years, the price of silver has been kept artificially low through massive paper trading. Banks and trading desks sell enormous quantities of silver contracts that are not backed by physical metal. This is called naked short selling. It increases supply on paper, pushes down the price, and creates the illusion of abundance. It works until it doesn't. It works only as long as most buyers are content to settle in cash and never ask for delivery. But when enough people demand the real thing, the math collapses. Paper promises cannot substitute for physical scarcity forever. We have seen this movie before. In 2011, silver ran from around $12 an ounce to nearly $50 in a short period of time. That was with a relatively stable financial system. This time, the backdrop is far more dangerous. Now we have banks under pressure, currencies being debased, and governments drowning in debt. When confidence in financial institutions weakens, capital does not sit still. It looks for exits. And physical metals are one of the oldest exits in history. Look at the supply and demand. Global silver production is under 1 billion ounces a year. Global demand is well over 1 billion. That means we are running a structural deficit. We are consuming more silver than we mine. The gap is being filled by above-ground inventories, but those are shrinking fast. Exchange inventories are down dramatically from just a few years ago. At the current pace, easily deliverable, silver is being drained far faster than most investors realize. Markets can ignore this for a while. They cannot ignore it forever. When available supply becomes visibly tight, paper contracts stop controlling the price. Physical buyers do, and those buyers are not day traders. They are nations and institutions trying to move out of weakening currencies. When that shift accelerates, price targets that once sounded extreme start looking conservative. This is not about hype. It is about structure. The same leverage that makes financial markets efficient in calm times makes them violent under stress. Now ask the bigger question. Why are authorities allowing this situation to persist? Why tolerate fragile banks, distorted markets, and accounting tricks? Because the alternative is worse. If governments and central banks openly admitted how unstable the system is, the response would be immediate. Depositors would rush for cash, markets would freeze, banks would fail in days. So instead, the truth is managed. Losses are hidden with accounting rules. Emergency lending is buried in technical reports. Optimistic language is carefully chosen. Not because officials are villains, but because they are trapped. They are choosing the slow burn over the sudden explosion. The problem is that every delay increases the size of the eventual reset. Debt grows, leverage increases, derivatives expand. The system becomes more top-heavy. History shows how this ends. Fiat currencies do not fail occasionally, they fail eventually. The average lifespan is a few decades. The dollar has already exceeded that average. And what happened this week should be unsettling because it was not even caused by a real panic. It was a processing failure, and it still exposed how sensitive the system is. If a technical disruption can shake confidence this badly, imagine a genuine shock. Imagine 10% of depositors trying to withdraw cash at once. ATMs would empty in hours, branches would close by afternoon. By the end of the week, regulators would be seizing institutions. This is not speculation, it is arithmetic. We saw a smaller version in 2008. One major bank failed, and within days, money markets froze, credit markets seized, and the entire system was on the brink. 4 days. That is how fast modern contagion spreads. The response then was massive money printing. Trillions were created to stabilize the system. It worked, but at a cost. Over the following years, the purchasing power of the dollar eroded dramatically. That was the hidden price of the bailout. And the next crisis will require even more money creation because the scale of the debt is larger. Which brings us back to preparation. This is not about panic. It is about positioning. Do not concentrate all your wealth in one institution or one asset. Hold some liquidity outside the banking system for short-term disruptions. Own assets that do not depend on a counterparty's promise. Because the pattern is clear. Financial systems do not collapse smoothly. They fracture, then fail suddenly. What happened recently was not random. It was a symptom. And symptoms matter more than official reassurances. Finally, pay attention to the signals around you. Watch not just headlines, but behavior, lines at branches, withdrawal limits, repeated temporary outages across institutions. Crises are rarely announced in advance. They are inferred from small breaks in the machinery. We just saw one. And systems that show stress under light pressure rarely survive heavy pressure. The question is not whether volatility is coming. It is whether you will still be relying entirely on trust when it does.